GM, good morning. Welcome to the Milk Road Show, the daily crypto show where we break down crypto faster than the Fed breaks your mortgage dreams. I'm your host, Jay Hamilton, and today we are joined by Capital Flows back again. Capital Flows is just one of the leading experts on understanding macro, understanding the Fed, understanding Trump, and that's all what we're going to talk about today is how do all these catalysts and these market dynamics, how are they playing together and what does that look like? Now, yesterday, you guys all know probably by now, the Fed kept the interest rate stable. Crypto markets have responded relatively positively, which is great to see. But at the same time, we got Trump has been publicly calling for the Fed to lower rates. Meanwhile, the Fed and Powell have really shifted their stance to more of a hawkish stance. And we want to understand, like, what does this all mean for crypto? What does it mean for markets? And what does it mean for your bags? Before we jump in with Capital Flows, if you guys do me a favor, subscribe, like the podcast, like the YouTube, wherever you guys are. It really helps us bring more great guests on the show. And we make the show for you so that we can all win in this market and create generational wealth. 1 second before we jump in to hear from our sponsors who make the show possible. Meet Odos, the DeFi aggregator that makes your token swap smarter, faster, and a whole lot easier. Tired of trading like it's 2019? Odos finds the best prices for your swaps across 900 liquidity sources and 14 blockchains, so you always get more bang for your crypto buck. Whether you're swapping, setting a limit order, or just avoiding gas fees like the plague, Odos has you covered. It's like having a genius trader in your pocket, minus the coffee addiction. Join 3 million wallets already using Odos to power over 6 billion in monthly trades. Start making smarter swaps today at milkroad.com/Odos. Capital Flows, welcome back to the Milk Road Show.
Hey, thanks for having me. I'm excited for the conversation.
I'm always excited to have you on, my man. Okay, let's start with the last time we had you on the show, you were, I would say you were long Bitcoin. You were feeling pretty good about Bitcoin. How are you feeling now?
Yeah, I think last time I was on, we had a really interesting situation in terms of where we're at with the Fed, with global liquidity, with everything, and it's been really cool because we've had a lot of developments since then in terms of the Fed stance, Trump's inauguration, the communication from the Trump inauguration or from the Trump administration into how they're going to have a stance toward crypto. So there's been all these developments, and all of them are actually pretty tangibly impacting crypto markets, interest rates, equities. So I think there's been a lot of interesting developments since we've last talked.
Mm-hmm. And it's amazing. You were on a month ago. I think one thing that everything shifts so fast and so quickly in the markets, and it's why it is, even if you are a buy and hold type of investor and you're not trading and you're not regularly making shifts in your portfolio, I'm sure that your stress levels are changing rapidly because the markets do change so quickly, and so much can change in a month. Okay, before we chat about the, we sort of have the macro regime, and then we have Trump and the Fed. And I want to talk about the Fed and the Fed meeting yesterday and what came out of that and what your takeaways were. But before we do that, I thought I would bring up, you shared a great chart. And for those listening, we'll try to explain it recently, of the S&P 500 since the beginning of November. And you basically broke down like, okay, here's the story so far in this bull run. Can you walk us through this so we all have the context of where we've come from and where we're at? Because I think that really helps understand where we're going.
Yeah, absolutely. So, if we understand the macro regime that we're in, so with growth, inflation, liquidity, and then we understand how the Trump administration is impacting that, and then also how how the Fed with Powell is impacting that. If you understand those three things, then you're going to be able to understand how and why assets are moving in the way that they are. And then that in turn allows you to take views that are informed on equities and Bitcoin and things like that. The chart that is in the display right here is the breakdown that I provided for what the progression has been for the drivers in the S&P, and these overlap a lot with Bitcoin if you just look at the correlation. So we've actually been in a range a little bit. The election hedges unwound on the very left-hand side, and actually during that time, after those election hedges unwound, I published some reports, and we also talked about this on the podcast, that I turned a bit neutral because you had a lot of these positioning unwinds, you had a lot of these changes. And, since then, we've actually had a lot of volatility and we've been basically neutral in equities. So that view is played out. But understanding the moves that have taken place in the interim inform what is likely to take place over the next 90 days. So we had Mag 7 outperformance, which just means you had all of these major names be the primary thing that pushed equities to all-time highs. As that took place, you had this shock to positioning because Powell came out as very hawkish in December. That was the sell off in blue. And then since then, you had a little bit of risk price into markets where you had some good news basically put downward pressure because valuations are high and some other things. And then you had CPI basically come in line and just below expectations, which caused equities to rally. And the big thing that has taken place, if you understand that Mag 7 has been one of the main reasons you've seen positive performance in the S&P, then it makes sense why the news out of China about DeepSeek and the AI there caused a gap down and selling pressure in the S&P on Monday, right? And that happened as we are moving into FOMC. So you have this little bit of a position unwind, and then we moved into this setup with Powell where he comes out and, what I would say for the FOMC meeting that happened this past week is that Powell intentionally didn't say anything that would indicate he's coming out with a more aggressive stance in on the hawkish side, right? He, said inflation is not making progress toward, their goals like he did last time. He didn't say that because we need to see a couple more inflation prints come in below expectations and, decelerate. But Powell could have brought on the table, some type of idea about rate hikes or something along those lines, but we haven't seen that, right? So overall, the Fed didn't cut. There's no meeting in February. And, right now in the models that I'm running and what we're doing, very unlikely to get a cut in March. Very unlikely. So you have this 3-month period of time where the Fed is basically not moving. They're pausing. And that means if you hold the Fed constant, everything that takes place in the Trump administration and in the macro regime, those two things are going to determine asset prices over the next, 90 days.
Let's talk about what do you think comes from those three things over the next 90 days? Because there's there is definitely, everybody's still very bullish on the year and the outlook for, and we'll get to talking about global liquidity later in the show, this belief that we are going to have this, QE, or maybe it's not called QE, but something from the US at some point. But that seems to be a little bit further out. So I think what everybody's really trying to figure out is like, what's the short term look like? What is the next few months look like? Are we going to see a rise? Because often Q1, especially in bull years, is one of the best. It is the best quarter for Bitcoin. But now I'm not so sure. We still haven't seen a 30% pullback in this bull run. We got a pullback. I think it was like 18% in December and early Jan. But so I'm trying to frame this all and help us frame how you think the next 90 days will play out. And if you want to talk about Fed first or Trump, we can go through each.
Yeah, absolutely. So when we think about what has happened over the past 2 years, we have had back-to-back years, 2023 and 2024, where equities and Bitcoin have had, major return years, right? Major high return years. The S&P specifically, over 20% returns both years, right? On a year-to-date basis. When you have that take place and you have valuations at these levels and things like that, that means that there's a higher hurdle to be able to, have returns and to adjust positioning and things like that. In other words, that just means you need to be a lot more specific and tactical in how you're taking views. So that's why we've had some volatility since those Trump hedges unwound and why things have been range bound. And that's why, I wouldn't be surprised to see, moves up, move down. I wouldn't be surprised to see us end the year flat in Bitcoin or, equities overall. Maybe we end up, positive a little bit or something like that. But a lot of the narratives around the bullish case primarily surround Trump right? And his new policies and things like that. And I think on net, the Trump administration policies are going to be positive for growth. But when I think about the Trump policies, especially how they impact crypto, I think about this shift that's taking place where I wrote an article about this that we've discussed, where, in my view, the Trump administration has shifted things for crypto so that there's actually some different risks that crypto faces under the Trump regime as opposed to the previous Biden administration. Under the Biden administration, we had a lot more, regulatory scrutiny. We had a lot more, kind of stance toward crypto that wasn't super positive. And now we're just flipping to the extreme opposite. But you'll notice the people involved in the Trump administration, they are people that are directly involved in the crypto industry, or they are talking their book and they have a bag, right? So if you just think about the main person for the Trump administration that is there heading up the crypto side of everything is David Sachs, right? And he has funds and investors invested in crypto funds, crypto VC firms. He has long exposure to crypto.
Mhm.
So
Yeah,
what
he's
he
an
does,
early investor in Solana.
totally, yeah. Like those guys talked about the top, and we're basically shilling Solana on the All In podcast. I don't know if you want to cut this out, but they're shilling All In Solana on the All In podcast at like the top, and I'm just like, you got to be kidding me right now. But they're talking their book. Talking their book, and you know what? Like I forget who said this, but they were like, "Hey, once you get a position, get long and get loud." That's what all these guys do, right? Don't these guys don't have your best intentions at heart, which just means understand the information that they're putting out there and why they're doing it, right? And so you're shifting where you're having these very pro business individuals or people that are actively involved in businesses. I mean, just look at the amount of people at the Trump inauguration that are just involved in CEOs at businesses, right? And major corporations. It's like every single person you could think of, right? All of those people want to be able to have an advantage in this administration and be able to have an advantage in government policy, right? And so we're shifting a bit where you're going to have a lot more concentration in these different type of business individuals, and what they're going to say is primarily going to talk their book and help them be in an advantageous position, as opposed to these people might have some reasons because they just want to help the country and things like that, but at the end of the day they are talking their own book, right? And so that shift is going to be really important because that is going to determine the signals and risks for crypto from a regulatory perspective and from a price action perspective, because these guys, like anyone else, will maybe try to push the price up and that they'll use it as exit liquidity, right? And
Mhm.
that's more of a risk than maybe the regulatory side under Gary doing his little thing, right? So that's kind of how I think about the shifts and risk.
Very interesting. That's obviously what led you published an article recently where you said the Trump administration is a massive risk for crypto. That's the risk that you see. I want to go back to you saying that you wouldn't be surprised if we ended the year where we are now. You're the first person to come on the show and to say
Oh,
that.
really?
Yeah, definitely. Everybody is got their bullhorns on and everyone's like, this is the year. Like, we're doing it. It's all going to happen. It's lining up. So I want to understand why do you think that we could end the year flat?
I think it's because I don't have a necessarily like really bearish view at the moment, right? I had some views moving into January that I was running some shorts and trying to take some bets to the downside and kind of see how that took place. But when you think about all of the major times for, let's just talk about Bitcoin, all the major times you had really exceptional performance in Bitcoin, every single time you had all three major factors of macro aligned, which means growth was positive, inflation was actually rising a little bit, and you had macro liquidity expanding, right? Typically when you have growth expanding, typically when you have growth expanding or inflation going up or something like that, and you have macro liquidity expanding, those are very unique circumstances, right? Like 2021 where the Fed held rates, below zero, and growth and inflation were taken off, like that's the reason why Bitcoin had outperformance. Now we're in this period where sure, growth is positive, but the Fed is not doing the same thing they did in 2021, right? They're not opening the QE pipes. They're not, cutting rates and holding them and pinning them to the ground aggressively. That just means that there is less factors creating this crazy tail scenario or this crazy outsized scenario where we move to 500K in Bitcoin this year or something like that, right? Mm-hmm. So that just takes, my stance and makes it more neutral, because I know that macro liquidity, probably neutral at best, maybe a little negative depending on what we see. And then on the growth side, that's probably neutral at best, just just marginally positive. We're probably going to stay above 2%. We might go down a little bit. We'll see. And then on the inflation side, that seems pretty neutral as well, which means we're probably not going to have a really aggressive cut in rates this year. So all of those factors coming together is why I don't have a super strong view on either direction. Mm-hmm. And until that changes, I don't really have an edge in predicting an extreme bullish or bearish scenario. And so I think, at this time, for the time being, I'll be, just be able to take the other side of extremes when, Bitcoin or equities or interest rates price an extreme, then I'll just take the other side of that, whether that's the upside or downside.
Mm-hmm. So let's talk about what would need to change in order for you to shift your view. And first, I want to chat about. Actually, I want to chat about global liquidity, but before we do that, because in my view, QE is still coming, but maybe you have a different take. So I want to ask you about that. But before we talk about that, you did say recently, because we've been talking about Bitcoin, that if you saw a close above 108K for Bitcoin, that would flip your stance. Tell us more about that.
Yeah. So we are in this range really for Bitcoin, and it does connect with the idea of global liquidity. But we have that high that we made from the inauguration, right? And we're in this range where we're between, let's say, 92,000 and 108,000, right? What we need to see is capital moving out the risk curve, and a weekly close above the 108 level in Bitcoin would be this signal that we're closing above that inauguration level, right? Which means there's more durability behind the flows. When you have these inauguration events, those are really overall just kind of a sell the news liquidity kind of turnover event, because everyone knows nothing durable is going to take place. Maybe we rallied into it and we sold off after it. That's not surprising, right? The question is, how is Bitcoin moving, and what is its correlation with other assets, and what's its correlation with macro liquidity? So in my models, I'll run a correlation of Bitcoin against every other asset, and then also against every major factor in macro. And I'll look, okay, let's say we close above that 108 level in Bitcoin. I'll look and say, has that occurred with these other factors in macro providing confirmation? If that provides confirmation, then I can actually get more aggressive, right? And I want to take all of these different signals from across every market and not just silo into one, because when I take all of those signals and bring them together, I'm able to actually have an edge that maybe some people that are just looking at Bitcoin don't have. So I pull all of those things together. And in connection with, macro liquidity and global liquidity overall, I think, we are at a stance where it's a little bit neutral to maybe just negative, just a little bit. And, you have, the interest rate side basically neutral probably for this year, because we're already pricing almost 2 rate cuts. So if we get 2 rate cuts this year, that's already priced in. And you have inflation probably going to roll over a little bit, but not as aggressively as everyone thinks. And we probably are not going to hit a 2% goal this year or something like that. But on the QE side, the recent meeting with Powell is they're still doing the balance sheet runoff. They're still adjusting things. They're not, actively doing QE, and there's not a really positive impulse from the Treasury that says they're going to, if you want to get technical, they're going to do more bills than bonds or something like that. There's not a crazy kind of setup for that. So, overall, bank reserves in the system and liquidity has been pretty neutral overall. And so until you see a shock on either the inflation side or the growth side, you're not going to have the Fed act with QE, right? Like they did that in the SVB crisis, right? Where like something blew up and then they responded, they increased, reserves, they, took on some more things on their balance sheet and things like that. Until we see that, they're probably not going to inject liquidity intentionally, which just means we're kind of in this, again, the range bound kind of neutral setup. And a lot of the bullish catalysts are primarily connected to, anything that, maybe, I mean, even if the United States did some type of thing where they bought Bitcoin or something along those lines, that doesn't seem like it's going to happen this year. I could be wrong on that, but even if they do, let's say they buy 6 billion, right, or 5 billion, that's not going to make a material difference on the overall float of Bitcoin, right? Yeah, maybe move the market for a day. But I mean, what you actually see is, ETF flows and MicroStrategy being the primary, factors taking a lot more of the float, right? So watching them is probably going to provide more of a signal than the Trump administration.
Mm-hmm. Uh, so what about the debt in the US? They just passed their 36 trillion debt ceiling. Is that not enough of a crisis for them to have to go into QE?
Yeah. So I actually just published an article today about how the debt situation in the United States and how the geopolitical situation in the United States connects with, China and the reserve currency of the United States. In my view, when you model the U.S. debt and things like that, yes, it sounds like a big number, but we're not at a place where we're going to feel the constraints of that high level of debt. So, in my view, sure, the number is really big, and sure, we're going to have to deal with that someday, and all of those things. On an investable time horizon, we're not in a debt crisis, right? So, I think you have a debt problem, but what is that debt problem from? It's not just from overspending. It's from the fact that you have the dollar as the reserve currency of the world, which means the United States can get cheap liquidity very easily. And if you want to get a little technical, the fact that the US is running a current account deficit, right? And they're importing a lot of goods and services, and they're also doing that with a budget deficit in the US government. All of that is kind of connected to a lot of the actions China has had and also the US reserve currency status. So, unless you close the capital account for the United States or shift the dollar's reserve currency status, you're probably not going to get away from this debt setup. And, the Treasury keeps issuing, bills and bonds, and the market continues to adjust and take them on. We're not seeing a situation yet where the market can't digest that. And we have to go to a situation like the BOJ in Japan where they're buying basically all the government debt at all times, right? So we're not in that situation yet where the market is not adjusting to that, and probably not going to get there on an investable time horizon over the next, 3 to 5 years.
Hmm. Hmm. Let's chat about the melt up scenario that you see building. First of all, explain what a melt up scenario is. Like that language is new to most of our listeners.
Fair enough. Fair enough. Yeah. So the melt up scenario that I see, which just means, having a parabolic rise and a complete push up in assets on the equity side and Bitcoin and everything else. The biggest comparable for a quote unquote melt up is the Nikkei in Japan when it had the Nikkei itself, the index, had a 90% return year. I mean, imagine the S&P is going to be. Imagine if I tell you, hey, the S&P is going to be up 90% this year. You're going to tell me like, no, it's not going to be up 90%. It's not,
That'd be crazy.
you're like, I'll take the other side of that all day, right?
Yeah.
But that's what happened in Japan, right? And why? It's because you had this, massive liquidity cycle that pushed up the valuations of assets to a level that was unsustainable given the monetary base, right? It's not just that valuations were high. Valuations high doesn't mean a ton. It's about what's pushing those valuations high in terms of liquidity, and can that liquidity be sustained, right? And so, you have this concentration in the United States from passive flows that are indiscriminate buyers every single day, right? Like your Vanguard and your, every single major, BlackRock and everything else are the major players coming into the market and buying every single day, and they're not selling. They're taking more and more of the float every single day, and the share of passive is increasing exponentially. And so when that takes place, on top of all of these major Mag 7 names becoming the main weightings in the index, it's very easy for a melt up to take place because no one's selling and everyone continues to put money into their 401ks until the unemployment rate rises. So, that's one of the reasons why we've seen a rise in valuations in the S&P over the past 4 or 5 years, is because passive as a share of the entire, index is increasing. And that's very different from the past, where people would put money in mutual funds and that would kind of get distributed over active management, and people would do stock picking and they would get all these different places. Now we have this idea ingrained in our culture that and basically across the entire world, that just buy an index fund and you'll be fine. That's a positive thing. I in a sense believe in that. I owned index funds and all that stuff, but that has a consequence on the microstructure of the market. And so you don't have a seller until the unemployment rate rises. And so, this is, something that is, talked about by a lot of different people. There have been people that publish papers. All of us that are in the industry and trade actively, all of us are very aware of these risks and how ETFs and all these new products, they create this crowded theater kind of situation where it's pretty easy for everyone to get in, but as soon as there's a fire, everyone rushes for the exits and no one can get out, right? Like that's what's creating for the market, which means you can have a parabolic rise on the upside, but then when you kind of come to the downside, you have a big problem. And the tangible implication and expression of that has been with just the option flow that we've seen in markets. It just continues to get shorter and shorter term, right? Which is not necessarily a bad thing, but when you have more and more of the options volume in the S&P and in every single asset getting shorter and shorter term, everyone is taking that exposure and they're using the option market to adjust their exposure because they know it's difficult to, order books are just so thin these days in terms of getting liquidity and things like that. And it's all in option flow. And so, that's what's creating most intraday moves now, right? That's why you're seeing, especially in the S&P, you have these crazy moves to either end of the range that just reverse, right? Like at the end of the day, right? And so, understanding that, those are all little pieces of the puzzle that build to this picture where, even if the macro situation doesn't change, if money keeps getting funneled into passive vehicles, that could, wouldn't be surprised to see, S&P at like a 7,000 or something like that in short order if that reflexive feedback loop begins to take place and the unemployment rate doesn't rise.
Right. So what you're saying is that parabolic rise could still happen, and then there could be a big drop.
Absolutely. I think it's when I structure ideas and trades around these types of ideas, it's recognizing that either of those things can take place and market timing is everything, right? Like that, like we could have the next 20% drawdown in the S&P be in 5 years, right? Like what am I going to do for the next 5 years, right? Like I can't be short for 5 years, right? And that 20% drop could be from, 100% higher, right? So, what I do in that scenario is just understanding those risks, and just something simple, not investment advice or anything like that, but just understanding like, calls are probably underpriced, right? And there's nothing wrong with buying out of the money calls, or those types of calls that maybe be longer dated, or rolling them or something like that, because those longer dated ones, there's all of that activity for options is primarily on the short end or on closer expirations, right? On mainly 0 DTE now, but under 3 months, right? So buying longer dated out of the money calls, actually an interesting strategy here for a melt up scenario. And if that doesn't pay out, then you are able to adjust to things, right? So you always want to manage that left and right tail. What's going to happen on the downside extreme, upside extreme, and then as we move through the interim, how do I trade actively or balance those risks?
Fantastic. Absolutely wonderful. Capital flows. Just the way you break it down is it's technical but yet simple, which is what we love here on the Milk Road Show. Before we let you go, when you step back and look at the rest of this year, what are the major catalysts or the major things that you will be watching? And I know we've discussed them throughout the show, but I think it's a good idea to sort of summarize and bring them together for everybody.
Yeah, I would say one of the primary things I'm watching really closely is what are credit spreads doing in connection with Trump or Powell? If I understand that, I am going to have a pretty good view on how the macro situation is connecting to policy, right? Because credit spreads are really low right now, right? Which just means financial conditions are not restrictive, right? Or not incredibly restrictive. So if that changes, then that is going to be an incredibly important signal for a regime shift. And then the second thing I'm watching is we are seeing an increasing geopolitical risk between the US and China that I feel like people are talking about less right now. I just saw a video the other day on Twitter and a couple other places where, China is not, technically allowed to have, semiconductor chips and things like that from NVIDIA and things along those lines. And, there's a video the other day of, Chinese founder basically saying, yeah, I got all these NVIDIA chips. Like, what are you guys doing?
They're doing it. Yeah.
They're doing it. They're getting them, man. That is a huge problem because that China is one of the major players in the entire world, and when they move or when they take an action, that is going to impact the US, especially if it is related to semiconductor chips, AI tech, and especially AI and crypto are getting overlapped right now. The very beginnings of that is like the virtuals protocol, right? Where you have all of these new AI bots connected to crypto coins, and now they're sending crypto back and forth between AI bots. That's just beginning, right? All of these things are getting intertwined. And if you have an action by China that has more of an impact on the United States, and then Trump responds to that with some type of tariff sanction or something, he'd have to do something very precise or have thread the needle, because there's all these different ways to get around them, especially when you have the resources like China does. So that understanding that is going to impact NVIDIA, semiconductors, tech, crypto. Like, that relationship impacts everything. And that's one of the things I've been monitoring on, writing articles about it on the Substack and everything else. And I would say those two things are the major things I'm watching this year.
Fantastic. We will, since you brought up your Substack, we'll link to it in the show notes for anybody who wants to check out Capital Flows. Incredible research and very well written for anybody who's active in the markets. Thanks again for joining us today, Capital Flows.
Thank you. Enjoy the conversation.
Always appreciate your time. Thanks for listening in, everybody. Have a wicked awesome day. As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your number one resource to help you invest successfully in crypto. One final note, this show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.